Welcome back to the third video in the futures series. Today's lesson is on future markets and the participants, and the goal in this lesson is to introduce you guys to the key participants in the futures market, and I'm going to explain the roles they play and whether for business protections or profit seeking. Okay, it's very simple. So now that you understand what futures are and how they differ from other instruments like we talked in the last video, we will talk about people and institutions who actually use futures. I kind of talked about this in the last video, but I'll talk a lot about it in this video especially. And in the futures market, there are two main types of participants. There's hedgers and speculators. Hedgers, these are companies, producers, or institutions that use futures to protect themselves from price volatility. They're not trying to make a profit from the market. They're trying to reduce the risk, remember? So I gave an example. Let's say a gold mine company might sell gold futures to lock in future selling prices. I also made an example with an airline. They might buy fuel or oil futures to stabilize its operating costs. So we talked about this in the previous lesson, but it's going to be more heavy on it this lesson. And then you also have speculators. These are traders who use futures to profit for short-term price movements. They're not involved in actual commodity or assets. They just want to buy low and sell high, or vice versa. And speculators provide liquidity to the market, and they take on the risk that hedgers want to avoid. So both groups are essentials. And then the future market includes a mix of participants, which we're going to talk about. So hedgers. If the future markets were a game, hedgers would be the people kind of playing defense, I would say. These are the participants who are trying to win big, so who are not trying to win big, but they're also not trying to lose, right? Their main concern is controlling risk and not chasing profits. They want to lock in their costs, not risk having higher costs, but also they're missing out on possibly having lower costs, but they're better off having a cost they're willing to lose than having a higher cost as well. That's why they have futures. So you could kind of imagine as like running a business where your costs or revenue depend on a price that changes every single day. This could be oil, grain, steel, foreign currency, whatever. And it's nearly impossible to plan a budget or grow when you don't know what your raw materials will cost the next quarter or how much you'll earn from sales overseas, right? So that's where the futures come in. It's a tool that lock in a no number. So what hedgers do is they use futures to bring stability to an unstable world, right? It might not sound flashy, but this is what keeps entire industries running smoothly. It's like how grocery chains can set prices in advance, how car companies plan production cycles, and how major exports avoid losing money to currency swings. And so while you won't see hedgers on like CNBC making bold market calls, or they're just the people who are quietly behind the scenes using futures to build certainty into a very uncertain environment. And I want you guys to remember that they don't use futures to make a killing. They use them so they don't get killed by price volatility. On the other hand, there's something called the speculators. So while hedgers are trying to reduce risk, speculators are doing the complete opposite. They're taking on the risk to try and earn a return. This would be your typical day trader. So if you see someone day trading futures, they're speculators. So speculators don't grow wheat, obviously. They don't fly planes or they don't buy physical oil. What they do is they're not involved in the actual business behind the assets. What they actually care about is price movement, if the future would go up or down, and how to profit from it. If they think crude oil will rise next week, let's say, they buy a futures contract. And what would happen is if they think the S&P is going to drop, they can also sell futures. So it depends. If they have an idea of where the stock would go, they would buy a futures contract to profit off that. They also don't have to wait. Futures markets move fast, and many speculators trade daily or even hourly. Also, while some are individual traders using online platforms, other are also large hedge funds, trading firms, or institutional players with big capital and high frequency strategies. It is important to understand that speculators aren't just gamblers. They play a critical role in the market. By constantly buying and selling, they create something called liquidity. And this means hedgers can enter or exit positions more easily. And what this does is, without speculators, the market would be slow and expensive to trade. With them, there's always someone willing to take the other side of the deal. In short, speculators are the ones making bold predictions and putting real money behind them. They're not here for safety, they're here for opportunity. And what I mean by liquidity is if there's no more speculators, people that are hedging the market, they're not putting that many orders every day, right? They're probably putting one order every quarter or one a month. It doesn't matter, right? But what speculators do is the amount of speculators that are putting in orders, it creates volatility, right? Because if you have more people longing the market, the price would probably most likely start going up a little. Also, obviously excluding news, um, tweets, all that stuff. But the point is, what the speculators are doing is they're putting so many orders into the market, and that creates volatility and liquidity. And what liquidity is since there are so many orders out there, people are trying to buy and sell. When someone that's hedging is trying to place an order, since there are so many orders that are already out there to fulfill, that hedger's order will go through easily, and this is what creates liquidity. This is liquidity. Liquidity is how easy it is to place that order, how easy it is to convert something, right? So with all these speculators going buying, selling, shorting, longing, same thing, that creates liquidity, which is good for hedgers. And so this creates a market balance between market hedgers and speculators. And so one of the most important things to understand about the future market is that hedgers and speculators, they need each other. You could kind of think of it like two puzzle pieces, right? They have different shapes and purposes, but they only work when it's connected. So hedgers enter the market to protect themselves from risk. They want to offload uncertainty, and they don't care about making money on the contract. They just want to control their exposure. On the other hand, speculators are willing to take that risk, but only if they think they will work in the favor. So what happens, you may ask? Well, let's say a farmer sells wheat futures to lock in their income. A trader buys that contract hoping wheat prices will rise, and both are happy. The farmer gets their certainty, so they get that price, and the trader gets the opportunity for the stock to go up, right? And this creates like a win-win exchange, but only when both sides show up. So you need your hedgers and your speculators. Speculators also keep the market liquid, like I mentioned. That means hedgers can enter and exit positions quickly at fair prices. Without speculators constantly buying and selling, prices would just jump wildly and hard to execute, like I said. Meanwhile, hedgers give speculators real world price activity to trade on, which is rooted in actual supply and demand in the market, right? So hedgers kind of look at supply and demand, and speculators have their own price action stuff. The futures market only works because of the natural tension, like I mentioned as well. And one side wants safety while the other one wants a reward. And in the middle, there's a transparent, liquid, and functional marketplace that is created. To finish it off, this lesson, I want to look at who's actually participating in the futures market. It's not just big corporations and Wall Street firms. There's a wide range of players, each with different roles. First things first, we have the commercial hedgers. These are real businesses using futures to control their exposure to price changes. These can include farmers, miners, manufacturers, airliners, exporters, but basically any company that's vulnerable to volatile costs or revenue. Next, we have the institutional traders. These are large financial entities like hedge funds, mutual funds, and pension funds. These firms are futures for both hedging portfolios and tactical trading. Tactical trading. For example, let's say a pension fund might use index futures to quickly shift exposure without buying or selling thousands of individual stocks. Then there's something called proprietary trading firms. There's often called them prop firms. These firms hire traders and give them capital to actively trade futures for profit. And what they use is algorithms, scalping strategies, and short-term positions to take advantage of volatility. So on the individual side, we have retailers, people trading. Sorry, before we get to retail traders, what prop firms are, these could be examples of like MyFunded Futures, Top Step, ETF, Apex. These are prop firms that you could sign up for and kind of not say work for them, but they give you an account with capital. It's gonna be paper trading unless you're really, really good and you show them, but it's usually paper trading. But they will give you an account and you will trade futures. If you make money, if you're consistent, if you show them that, for instance, you have a month worth of trading that's all profit, they will give you a live account. And when you get into that live account, there's not that many people that get it. It's hard to get it. You got to be very consistent, have a good strategy, whatever. You got to show consistency. But when you get this live account, you are basically working for the prop firm. You make the money, and in return, they give you a percentage. Usually, it's a win-win because you are making a good amount of money, And even that percentage cut for you is still a lot of money. Obviously, it is best if you have your own account with your own capital so you don't have to split anything. And it's also better for tax reasons. But yeah. There's this also on the individual side, we have retail traders. These are people trading from home on platforms like Thinkorswim, Interactive Brokers, Ninja Trader, you name it. They typically trade smaller contracts or micro futures to manage their risk. Usually, people who are individual traders usually trade micros. And if they're trading minis, they're usually trading between 1 to 3 contracts, at most 5, because 5 is still a lot of money at risk. Personally, I'm a retail trader. But I'm a retail trader, but I do a bit of proprietary trading with firms. But yeah. And then there's market makers. So these are professionals. They're also sometimes firms that consistently post buy and sell orders to keep the market moving. They don't necessarily have a market view. Their job is to provide liquidity and earn the spread between bids and offers. So whether it's a coffee company hedging supply costs, a fund rebalancing exposure, or a trader bidding on interest rates, the future market is filled with different amount of people, or players would say, all using the same tools for a different reason. That pretty much sums up this lesson. I hope you enjoyed it, and there's going to be another lesson coming out soon. Thank you.